Hey, good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Market still digesting the Fed from last week. Now, Powell the chair did not really take much off the table. Certainly, though, saying we'll be guided by the data, and then saying, in fact, we will be led by the data. Atlanta Fed President Bostic coming out over the weekend. We don't think he signaled 50. But again, it's solidification of the fact that the Fed is not taking anything off the table at this time. And certainly they don't know. We don't know. Humble and nimble. Jack be nimble, Jack be quick. This is more like pin the tail on the donkey. We had some very smart people at the start of this year saying no rate increases for 22. And now we have equally some very smart people saying 7 rate increases for 2022. Market pricing right now gravitating around 5. What we've written to clients about and where we find our conviction, certainly the speed in which we get there now is being front loaded. But if you go back to pre-pandemic, because the market, keep in mind, the market is looking for context here because we don't know. We throw this gargantuan balance sheet into the mix. We have rate increases. We have very little context for this period of time. And the chairman, in fact, said that last week. We just don't know. What they do understand, what the Fed does understand specifically, more so with regard to financial conditions and trying to slow down the economy, inflation, or rate increases. But we just don't know. But if you go back to context to before the pandemic, we had a funds rate at 150. We had an unemployment rate now, which is through 4%. We have very tight labor market. The chairman referred to that multiple times last week, saying it's remarkable, and it is remarkable. We'll get another number this Friday. But if you look at the core PCE, the Fed's favored measure that came out on Friday, and granted, most people expect inflation to come down, and so does the Fed, but this has been going on now for a long time. It's running more than 2.5 times where it was back then with a 150 funds rate. So what we've been saying to clients is, look, the first 100 basis points here is autopilot. Could we get there by mid-year? Yes, of course. Could we get a 50 basis point bump along the way? Yes, I think the answer is absolutely yes. You certainly can't rule it out. Whether they start there or not is a different question. So we need to get back to something that looks like normal. I mean, all the Fed is really doing here, if you look at the 13.3 programs, peeled off. If you look at the end of asset purchases now ending in March. I mean, if they were going to go 50 in March, then why not just end those asset purchases last week, which they didn't. So the signaling is getting a little confusing, I think, but the skew is very clear. It's toward more, not less. And the Fed is certainly giving the market a bit of a green light to go ahead and do that, test the waters. And the reality is, though, emergency rate conditions, that was part of the pandemic measures put in place in 2020. So in the chairman's words, we're going to move steadily off those levels. It's long overdue. The Fed knows and realizes that they're late on asset purchases here. Why they continue to buy, we don't really know. But all you need to do is look at the liability side of the Fed's balance sheet to know that they've overdone it here with regard to ample reserves. And we're going to start taking that back. But it's a process. But with regard to rate increases, getting from 0 to 1% is the easy part. You know, we put out a chart on 2-year notes over the weekend. It formed the basis of our weekly from Friday. If you look at that chart, getting to 150 is the easy part. And you can see the pre-pandemic gap and getting back to those levels. The question is, where do we go from here? What's the next leg? Is it back to 2018 where 2-year notes were at 3% and we had 10-year notes at 3%? Are we going to move higher? Are we going to shift the curve higher and flatten as we move all rates higher? But one thing is clear right now. One thing is clear. The market is leading the Fed. The Fed is more than willing to let it run here. Chair Powell referenced the yield curve. We've been pounding the table about this. It's important. It's only one metric, but it's very symbolic metric. And if you look at how inflation went from Wall Street to Main Street and how that impacted the process around the nomination process of a new Fed chairman, how that's impacting now everyday lives. If you look at the yield curve equally too, we still have some slope, but relative to 75 basis points, which was referenced last week, now we're 15 basis points flatter. We have certain parts of the Treasury curve that are already inverted. If that 2's curve continues to flatten and at some point threatens inversion, there is no question about it that dialogue, the narrative around that will certainly play into Fed policy. But for now, what we see is a Fed that's more than willing to let this market run, more than willing to let this market price in what it needs to price in. The Fed said explicitly, financial market volatility, that's fine. Consumer balance sheets are strong. Financial instability is something entirely different. So we expect more volatility ahead with regard to risk assets. And we also expect this market over time to continue on a global basis for markets to continue to challenge central banks until something changes. Wishing everyone a great week ahead. We get multiple central bank decisions this week. And in conjunction with that, the highlight will be the employment number this Friday. Have a great week. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities.